So what stage of the cycle are we in with the commercial property market?
Look, in most of these markets we've seen the bottom and we're starting to pick up. The question is where we pick up to. And to see that, we need to understand that we came from a period during the financial engineering boom where prices were overvalued. Financial crisis triggered a correction in prices and, of course, problems in a lot of our markets. But the correction is over and now we're starting to pick up again. But along the way, the banks were aggressively getting people to reduce gearing, so we stopped building. So in the commercial markets, we're not building enough. Demand is coming through as the economy recovers, and while it's slow, it's recovering quite well. And the next stage of this is that as demand proceeds, we'll see tightening leasing markets lead to rising rents and rising property values. Now we have to understand that after the financial crisis triggered the correction in yields was just phase one of the process. The thing that we haven't seen yet is a rise in rents. And it's the correction in prices has left prices in many of these sectors below replacement cost levels. And so even when funding comes back, we can't really start to build again really quickly. And so why should rents rise to underwrite financial feasibility? The answer is nobody's going to do it because they feel nice about it. Because demand is exceeding supply, tightening leasing markets will feed through to rising rents. Now it's quite different sector by sector. In the retail market, well, that's pretty much the darling of the investment community. We saw the correction in yields, but we didn't see much impact on cash flows. And so for retail, it's already business as usual. Yields are firming again. We won't see the 2007 yields for a long time because they were overvalued, but retail's doing just fine and will start to be building again quite soon. Industrial property similarly overreacted in the financial engineering boom, corrected in the financial crisis, and we stopped building. So now, as we start to build again, we will see rising rents come through to underwrite financial feasibilities, but slowly, because those markets are really competitive, particularly places like Sydney and Melbourne where there's a stack of land available for development of new industrial premises. And it's really competitive out there. In the commercial markets, well, we're well below replacement cost in most markets. There's a bit too much oversupply in Brisbane and Perth, but nothing major because the financial crisis took the heat out of construction. Melbourne's already reasonably tight. Sydney's about a year behind Melbourne, Brisbane about a year behind that, Perth similarly. But the point about all of this is we stopped building. And so there are still a few buildings coming on that started before the financial crisis hit, but after that there's nothing. And as demand comes through, leasing markets will tighten up really quickly. So what's happened is that excessive caution by banks and by equity markets has led to substantial underbuilding, not enough to service increasing demand in what will be a solid growth story over the next 5 years. And as that happens, we're looking at commercial markets. So Sydney, Melbourne and Brisbane rents will double in net effective terms. You've got that, double. And when that happens, of course, yields will firm, investors will come back. And so there's a boom coming in these markets, in the commercial markets.
So we're in the upswing phase of the commercial property market. When do you think we can expect a boom?
So in the commercial markets, so Melbourne will be first cab off the rank in the upswing. But there are long lead times in commercial projects, which mean that we're not going to get substantial new space on the ground for 4 years, really. We can't really make any but a few projects work now if we give away the land that they're built on. But at the end of the day, the rise in rents will underwrite a strong surge in construction. So leasing markets will be tight, sub 5% vacancy rates for about 4 years before a peak in the market in Melbourne about 2015 or 16. Sydney, both the upswing and the peak are about a year behind, and Brisbane and Perth a year behind those as well. So it's long.
Given that we're in the recovery phase of the commercial property market, is A, now a good time for investors to get in? And B, should they be looking at the long term rather than just getting in and getting out of the market straight away?
Well, different markets are subject to different prospects, so be careful about yields that you're willing to pay. But with that caveat, so yeah, this is an excellent time to buy when nobody who really should be buying can buy, and some are not willing to buy, and nobody's willing to finance. No, this is an excellent time to come into the market. And you're crazy to look at property on a 1 to 2 year horizon. You always need to be looking at a 3 to 5 year. It's rare, though, that we have so long in a maturing market, which now will build momentum into what will become a boom by the end of it. So this is the time to take a position for returns 3 to 5 years from now.
Which sector is supposed to perform the best in the commercial property market in 2011 and even beyond that?
Well, look, we're bumping around the bottom of the cycle, just coming off the bottom. Who's going to do best in 2011? Well, probably office, but retail's okay. Although weak retail sales will mitigate against that. But there's not much in it. This is nothing compared to what's going to happen 2, 3 and 4 years from now. Office is my pick of them by a long shot, because supply will be so tight and there's such a long lead time that we're going to see very strong rises in rents before we can satisfy demand.
So you talked about the fact that Melbourne and Sydney are supposed to perform the best in the office market. Does that mean investors should be looking to buy into those markets, or should they be looking for markets that are perhaps expected to do well down the track, such as Brisbane and Perth?
I mean, if you're talking about smaller investors, there's a limit to how much they can spend. And so they're pretty much closed out of reasonable quality buildings in Sydney and Melbourne. There may be some opportunities in Brisbane and Perth, perhaps because there's more ownership which is still highly geared and under pressure from the banks. But at the end of the day, for most smaller investors, the best way into these is to go through the listed property trusts, where now we're getting the listed property trust at less than the asset value, and we get the attached business for nothing. Now you have to do that carefully. You have to target the markets you're investing in. You haven't got the control, but to me there are bargains in the LPT arena.